Hi everyone, this is Isaiah Rial with Laguna Wealth Advisors. Today I'm doing my March 2019 market update as well as the first quarter 2019 market update. Let's go into it. So today's Friday, March 29th. We're a couple hours after the stock market close. In my industry, in the finance world, in Wall Street, we look at things on a quarterly basis. So we take things at 3-month intervals. We want to see how the economy does in a 3-month span. We want to see how companies' profits or revenues, or their losses too as well, do in a 3-month span. We take a look at how countries are growing or decreasing in a 3-month span, everything in between. And so today, because it's the end of the quarter, it's a good time for myself, but also to the industry, just to take a step back and see, okay, what's happened in this last quarter? You know, what good news, what neutral news, and what negative news has happened? And so I've been doing that here for the past hour or two, and I want to share this with you because it's fresh. And so I've been taking a look at CNBC. CNBC came out right after the market closed, and they said, best quarter, so best first quarter since 1998. I took a look at the Wall Street Journal. Wall Street Journal is saying is all 3 major indices, the S&P 500, the Dow Jones, and the Russell Index, are all up over 10% this quarter. If you showed that to me without knowing anything else, I'd be like, wow, the economy's doing well, stock market's doing well, oh my gosh. I mean, people would kill to be in that. In this case, though, I feel that we need to take a little bit more of a longer approach where let's peel back the layers and not just look at what happened these last 3 months, but what's happened the last 6 months. So we just had the best quarter in quite some time. But when we peel back the layers, the last quarter of 2018, so October to December, we had the worst quarter since the Great Depression. We were down over 20%. So when you put those things into perspective, it's sort of, well, market should have been up the first quarter because we were down so much in quarter 4 of last year. Well, we're due for a rebound, and hence we got the rebound. When you take a little bit more of approach, where we are right now in the stock market was where we were about the second week of October of last year. So if you look from second week of October till now, not much has changed. I mean, yes, we went down quite a bit. We've come back up, but you know, we still have some room before we go to the all-time highs. There's still some things out there that people are looking for when it comes to the trade deal, when it comes to Brexit. There's a little bit of uncertainty out there right now. And hence, you know, that's why I think markets have been a little bit more jumpy here as of late. Got a lot of the returns the first couple of months of the year. March was a little bit more flat. There's a little bit of uncertainty out there. Not a bad thing, but it's just something, I mean, as a financial advisor, my job is to help my clients make money, yes, but also to help protect that money. And so right now I feel, yeah, I'm making money for a client, but I'm a little bit more on the protection side right now. And so with that being said, you know, I got a great question asked by a client the other day, and it's this, is, you know, okay, what's happening around the world? What do we see for America moving forward? Because they saw stories from Venezuela, and they're talking about Brexit, and then we heard about Asia and everything else. So we talked about that briefly. And, you know, right now I like to put it this way is, you know, our economy, our world is global. Everyone's intertwined. And so right now, America's still the strongest economy. When we look at the indexes and the metrics and the models that I use, domestic equities, which are stock markets here in America, are still the strongest out of any place in the world. Second, it is international, but by a very wide margin. So still America is the best place to be. When it comes to that, people from Latin America, they're putting their monies over here in America. Europe right now, because Brexit is still going on, and in fact, you know, if you go to the banks over there in Europe, some of them are still offering negative returns. I mean, that if you put your monies in the bank, you're not going to even get a positive return. They want you to spend the monies. They want you to put the monies back into the economy. So same with the Asian markets too as well. They're moving some of their monies over here as well. And so with that being said, there's more money coming into the market, and hey, more money is going to be put to work in the stock markets to help boost it moving forward. So But here's an interesting thing, and things are changing, especially here in March, but also too moving forward. Specifically in March, the Treasury yields, they inverted for the first time since 2007. When the yield curves invert, that's the first signal that a recession is looming. It doesn't have to be a bad thing, but it's just an alert for something for us just to put our minds to, okay, hey, a recession may come. And so when I saw that, it's time for me to put my ears up, to perk my ears up, but also too, it's a good time for me to look at my clients' portfolios and see, okay, are we positioned correctly? Because, yes, my clients have been making money, which I'm very grateful for, and I'm sure they're happy. But also, too, a very important part of my job is to make sure we protect those profits and to make sure we protect the principal that they have. And so with that being said, is I'm looking at, okay, well, these indicators are starting to come up. Things are changing a little bit out there in the economies. Are we in the right spots to have our clients' monies right now? Am I putting my clients' monies in the best scenarios possible right now for a good market or for a recession looming? And so I took a look at that a little bit further, and yeah, right now we are. So looking at these metrics is typically when a recession comes, there's defensive investments that come to the fold. What those are sectors that tend to do well in good markets, but also to bad markets. And when you take a step further, they're typically markets that will always have a need. So a couple examples is healthcare. It doesn't matter if markets are good or bad, people are going to get sick. People are going to need healthcare. They're going to need help. That's always going to be a need. And so that tends to be a sector that does very well during recessions or when markets start slowing down. Utilities, same thing. At our homes, at our apartments, at our offices, we still need the gas for the heat. We need the electricity. We need everything in between. Utilities tend to do very well. I've been sharing utilities with you guys for a few months now, and I've been putting that in my clients' portfolios. And also, too, technology is sort of becoming part of that fold where, it's risk on, risk off. If we want to take a little more risk, yes, there's specific areas within the technology sector that we can try to get some further growth for us. Obviously, it's going to cause more risk, but hey, that's an option for you. There's also some other areas now that are technology, but are blue chip companies that have been very solid and will give us solid returns. Granted, not going to give us astronomical returns, but they're starting to become a tried and true, a blue chip, where in good markets or bad, they're still going to push and chug along and get returns. So technology is starting to be a part of that too as well. And so I've been sharing some of this with you in the past market updates, and today that's what I want to share with you is, hey, these sectors right now are doing very well, and I've been sharing with them as technology, healthcare, utilities. But also, too, these are the sectors that are typically going to do well when recessions come and when the market starts slowing down. And so I want to share that with you because obviously you deserve the right to know that, and also, too, hey, protect your own monies that you've made. Another thing that I've seen is utilities jumped over healthcare. So now the best sector to be in based off of returns and looking to outpace what the S&P 500 is going to do is technology, number one. Number two now is utilities. That has changed. So number two now is going to be utilities. And number three is healthcare. So those are still the top three sectors when it comes to, hey, ways to get growth for your portfolios when it comes to the equity side. But now if you want to get a little bit more nitty gritty, utilities is number two versus healthcare. Fixed income actually tended to do pretty well, which is those are the bonds, more conservative investments. They did actually not bad for the first quarter. Granted, for my clients, for my portfolios, we're focusing more on CDs just because they're a little bit more easier to access, and we don't want so much of the fluctuations for our clients. We're putting into money markets too as well. Some of our clients have a high yield. High yield did about 7% returns for the first quarter, which is pretty darn good, but obviously there's a little bit more risk there. And so a couple things happening there, but big picture is, hey, markets were positive for the first 3 months of this year, which is great. We're back up to where we were in October of 2018. So we've picked up a large chunk of what we lost there the last quarter of 2018. There's still some very positive things happening in the markets. Like I mentioned, the year before an election tends to be very well in the stock market. It looks like Trump and the administration wants to get a trade deal done with China. If that were to happen, that may be a good thing in the markets. We're going to take a look at what the Fed does when it comes to interest rates. Are they going to keep them where they at steady, or are they going to decrease interest rates? I think they're contemplating that right now, so we'll see what happens there. But most importantly, when it comes to your money, when it comes to your investments, we have to protect ourselves long-term moving forward. I do expect a recession to come here, within the 12 to 24 months. Granted, right now, markets are still doing very well, which is good. But at the same time, too, we just need to start preparing and start thinking and start talking about ways to help protect the portfolio. But in reality, we've already been doing that for quite some time. And with that strategy, we're still making money for clients in the technology, healthcare, utilities sectors. So, my friends, I want to share that with you today. If you have questions, if you have thoughts, give me a call or send me a message or whatever you want to do. I look forward to talking to you soon. Have a great day and take care. Make it a great day. Bye-bye.